Hi, I'm Cliff Ennico, legal and tax editor of itsyourbiz.com, with some thoughts on financing your startup business. So, you've been downsized from corporate America, you've been out of work for a while, you're setting up a business for the first time, but where's the money going to come from to get this business off the ground? You don't really have a lot of assets, you can't take out a business loan because the local banks aren't lending, but you do have this big, fat, juicy 401k sitting with your former employer. Is there any legal way that you can tap into that to set up a business for yourself? The short answer is yes. There are two ways that you can do this, but they both have their advantages and disadvantages. The most common way to tap a 401k to set up a small business is what we call a rollover as business startup, or ROBS. Basically, here's what you do. You set your business up as a C corporation, your new business as a C corp. The C corp then sets up a profit sharing plan. And this is important because under current law, only C corporations can have profit sharing plans. Once the dust settles on that, you then do a qualified rollover of money from your 401k into the profit sharing plan. That has to be done within 60 days or else there's taxes and penalties and all kinds of bad stuff. Once the money is in the profit sharing plan, the profit sharing plan then purchases shares of your C Corp over time. That's how the money gets out of the profit sharing plan and into your C Corp, and you use that money to start your business. A lot of people use this method when they're buying franchises for the first time because the franchises want a big chunk of money up front, and it's very hard for most people to come up with that money. A lot of people do these 401k rollovers to finance the initial franchise fee when they buy the franchise for a first time. So that's one way you can do it. But a lot of people don't like to do it that way. First of all, it's a lot of hassle. There's a lot of paperwork. You're probably going to have to pay a company somewhere around $5,000 to $6,000 to make sure that this is done in the proper way. Also, too, there are rules. Because you're setting up a profit sharing plan, there's reporting that has to be done to both the IRS and the Department of Labor every year. You got to pay advisors to help you with that. Also, too, because it is technically a retirement plan, you have to make this profit sharing plan available to all of your employees on an equal and non-discriminatory basis. You can't just hog this thing for yourself and give your employees SEP IRAs or something else. You have to make sure that they participate in the plan on equal terms, and the paperwork there can be awfully messy. So what an increasing number of people are doing is they're saying, look, forget the 401k rollover. What I really want to do is just set up an IRA, roll my 401k over into the IRA, and then have the IRA make loans or distributions to my business to give me the capital I need. Can I do it that way? The answer is yes. Here are the pros and cons of using an IRA as opposed to a profit sharing plan. First of all, you don't have to have a C Corp. If it's an IRA, your business can be a sole proprietorship, an LLC, a partnership. It can be anything. You're not restricted to a C Corp. So that'll save you some money off the bat. The second thing you need to know, and that's the good thing about it, the second thing is it's a lot easier to roll 401k money over into an IRA than into a profit sharing plan. The paperwork is less onerous. Also, too, because the IRA is not technically considered an employee benefit plan, you may not have to share the IRA on an equal and non-discriminatory basis with other employees of the business. You may be able to keep that as just your IRA and give your employees another type of retirement plan. Now, that's a question you have to ask a good tax lawyer or tax accountant about, but I think you can do that. Those are the good things about using an IRA, but there's one bad thing which may counteract all the good things. When a profit-sharing plan purchases shares in a C Corp, that is not considered a taxable transaction. It's a tax-free transaction. When an IRA makes distributions to your business, and especially if you are under age 59 and a half, that is considered a premature distribution from the IRA, and you will have to pay taxes on that, and you will also have to pay a 10% penalty on each time you withdraw money from your IRA. So that is the downside. While the 401k rollover into the C Corp is more complicated, it's an entirely tax-free transaction, whereas a rollover into an IRA, when the IRA pays money out to your company, it will be a taxable transaction. You need to run a spreadsheet and make sure that the cost of doing the program and additional taxes is worth the benefit of having it done quickly and easily so you can set your business up faster. You will need a good accountant for this. Make sure you get one. There are some companies that specialize in doing these IRA rollovers. The three leaders of the pack are Benetrends.com, Benetrends.com. That's Benetrends.com. Guidant Financial, which is Guidant Financial.com. And for those of you who are doing this to buy a franchise, franfund.com, which is FRANFUND.com. They have plenty of information on their websites to help you make the decision about whether a C Corp rollover or an IRA rollover is the better solution for your business. I'm Cliff Ennico for It'sYourBiz.com.